Good. So welcome, Mikaël. Pacot is head of Euro rates money market at AXA, not AM, IM, and David Gorgone, senior client portfolio manager at Pictet, based in Switzerland. So coming especially for us today. So thanks for coming and joining us tonight. So let's try to talk about how to build a portfolio of short-term investment to mitigate counterparty risk, and also to talk about the fact that potentially why not investing in different money market funds, because they are not all the same, I guess. So maybe a first question for both. What will be your recommendation for building this kind of portfolio investment to reduce the counterparty risk? You want to start, Mikaël?
Maybe we had some discussion already, or the panelists that discussed about regulation. Very important to talk about it. So it's setting some rules for diversification, for eligibility of assets, also in terms of monitoring of shareholders. So on that front, I would say it gives a kind of a minimum background and kind of safety net for investors. And then you will have risk control, internal guidelines that will set up some additional constraints. So in terms of internal ratings, you can say there is credit analysis. We have some analysis that will check the credit quality of the instrument issuer we put in our portfolios. Then we have a risk team that will put some guidelines depending on the credit quality, put some max exposure by issuer or by group of issuer. Also put some constraints on the maturities of the issuers, taking into account the rating. So it's a way to limit risk and counterparty risk. It's also level of liquidity in a portfolio. We spoke about the 7.5 minimum required by regulation, but most of the asset managers have more than that, 20, 30%. Shareholders, we know them, their behavior, so it's also a way to look at it and mitigate most of the credit risk. And last point, about risk management and diversification. It's also active management. So when you have negative news, when there are some, different macro elements, you can take them into consideration and maybe sell some assets when you think you have some risk of downgrade or spread widening.
And David, maybe to comment and how to best select money market fund, because we saw several money market fund managers. So how, as corporate, should we, let's say, look at money market fund when it's question to select the right managers?
Yeah, I think it's key and it's an important question. But just before that, to complement what Mikaël just said, in a simple way, I think that to build and to help mitigate the counterparty risk, you have two main factors, two main tools, which are first diversification. It has been said, explained, and it helps, mitigating the counterparty risk, avoiding some events that can be predictable. But also, sometimes you cannot predict the unpredictable events. So for that, you need diversification and also a very strong credit selection process, just to make sure that the portfolio can be impacted in a very small way and can respond very actively to the event in the market. Now, coming back to your question, how to select a money market fund, and this is very important because we see a lot of different funds offered by the market, but sometimes several money market funds are exposed to exactly the same issuers. So you end up with the same exposure, the same risk. So you think you are, mitigating the counterparty risk, but at the end of the day, you are exposed to the same issuers. So it's very important to look at the transparency of each fund to make sure that when you invest in 2, 3, 4 different funds, you are exposed to different counterparties, different corporates or banks. And this is why it's important to look at the investment universe that is proposed by each asset manager.
So you advise to have a look at the, let's say, portfolio on a regular basis, just to make sure that across the different
Yes,
money
and
market
to
funds.
speak to the asset manager also to understand how they build their portfolio, how they approach the counterparty risk or the credit selection to avoid being exposed to too much to a single issuer.
Do you agree, Mikaël?
Yes, I mean, there are some discrepancies or difference between money market funds, between asset managers. Risk appetite can be slightly different. Internal credit assessment can be different. So we've seen different type of score or scoring, internal scorings. But sometimes you see, and we see as fund manager, we know that some have some different approaches. So good to look at it. Also good to meet with fund managers. It's good to know who is managing your portfolios. Discuss about the way they approach the market, what they see, how they think liquidity, how they address it in a portfolio. Also look at the line by line. It's very important. And then it's all the resources that an asset manager can use. So it can be a quant for mark to market, mark to model for the valuation. It's risk control to make sure that it's well staffed to make sure that everything is under checking, I would say, for the rules and constraints, regulatory one and internal one. And also maybe looking at performance, historical performance, look at volatility. It's things that help. And maybe last point is seniority of the fund manager, so stability of the team. It's also something very important.
Yeah, but performance, I totally agree. But as you rightly say, so it's afterwards, so it's difficult to anticipate that the future performance will be as good. But okay, to talk to the manager, I like the idea. Although I'm sure that a lot of our members are not doing that because they outsource and they consider it's outsourced to fund managers. So why we're rechecking the job of the manager? But I totally agree with you. So we know some corporate investing 100% of their cash into money market fund, and sometimes with, let's say, undecent amount of cash, because we know that we have piled up cash, and at the end of the day, first you need to diversify, because the more money, so you have some limits, even with money market fund, and then it's good to have daily liquidity, but I'm not sure that we need 100% daily liquidity. And when you start looking at the different lines, I totally agree with you. The risk is to be over-concentrated on, I don't know, Italy risk or one specific issuer. And so I'm not sure that we are equipped with our tools to do this kind of analysis. Have you seen sophistication from your client?
Yes, I think that investors become more and more sophisticated on that front. But again, to come back to the previous point, the point is not to do the same job as the asset manager or the fund manager, but it's just to know and to control and to know where the fund goes, basically. When you invest in a bank deposit, for example, you don't know how the proceeds is used. When you invest in a money market, you know exactly line by line and the amount where your money goes, and then you can check. And the transparency of the funds, I think it's key. Huh? It's another tool to make sure that the way it is invested is aligned when you're, as an investor, conviction, or we talked about ESG, but it's also your risk appetite. So it's very important to look at the investment, the underlying assets, to make sure that it is aligned with your convictions. And you know, we talked about concentration. It's true that sometimes we can have 4-5% maybe at the maximum an exposure to a single issuer. But if you invest in bank deposit, for example, even if you have 5, 6, 7 different banks, you cannot compete with 150, for example, different lines that you have in a short-term money market funds.
I still believe that there are some discrepancies and differences between funds, and maybe back to 2011-12 during the Eurozone crisis. I mean, there were some funds that had a pretty heavy exposure to Spain or Italy. Some had none. When you look at a sector or country exposure, you can see discrepancies. So sometimes there are more corporate exposure or less. So there are differences, and then also depending on you have Italy 1 month or Italy 12 months, it's different. So also in terms of interest rate risk management, you can have a fully hedged portfolio versus Ester. You can take some interest rate risk. So on some time, one can differ from one to the other. While, which is the credit risk, it can be at 200, 300, or 150. So these are criteria to look at, pretty simple. You can compare. You also have ESG guidelines, so some have a label, are articulate, and it's also something to take into consideration. What is extra financial is also helping to avoid the Credit Suisse story or some other problems. Or back in 20. It was 15 Dieselgate with Volkswagen, for example. You know, all the governance issues where things that could have been captured via the ESG management.
And David, do you think it's well being in Switzerland? What is your view on EU, including the non-EU? But is it cultural? Because we have the impression that in some areas, some corporates are more, let's say, keen in investing in money market fund. In some countries, it's not yet. Is it a question of education, of culture? We know in France that there is an historical culture of money market fund for historical reason, Anglo-Saxon world. But what about the other countries? I have the impression that some countries are less, let's say, although things are changing.
Yes, definitely. But I think that things are changing. Now, money market funds are becoming a tool for cash management. It was not the case maybe 10 or 20 years ago, but now, after going through all the crises, I think that investors have understood that money market funds are very attractive in terms of yields, but in terms of protection as well.
Yeah. If you are publicly listed companies, I think it will be difficult to defend and to explain in your annual report how you invest your cash and explain that you invest directly in paper issued by other corporates. So it's really difficult. But I remember a time where some of my, let's say, fellows, corporate treasurers in Germany were investing directly in CP of other corporates. So I don't think that it's our, let's say, nature and social objective to invest in
No, and from an operational standpoint, it's quite difficult. You have to roll all the maturities and look at the maturities. So I think it's delegating your cash allocation to a professional. It's also can be quite a good benefit.
I would say it's a full-time job. So when you manage a money market fund, you are in front of your screen. You have to check who is issuing the market, what are the level, what the ECB is doing, where the interest rates are going. So plenty of things to look at. Credit analysis for sure is very important. So you need some staff, some other resources to look at. So it has also a cost. So if you have to replicate all that at a corporate level, it will be much more costly than just investing in a money market fund. So I think that's something to take into account, and also maybe the job of the treasurer has changed over time, and maybe it's good to delegate and focus on other things. Plenty of things to look at. Funding, also issuing in the market. All the ESG staff can be part also of the job of the treasurer and the financial directors. So. Maybe it's a way to well allocate your time to delegate part of your cash or invest your cash in money market funds.
Maybe a tricky question, and apologies in advance for that, but you are not, let's say, core banks used by many corporates. So is it an advantage not to be a big core bank when you manage, let's say, money market fund? Some people could be tempted to say, okay, let's work with our core banks. Why? Let's say, what are you telling to your customer when you try to convince them to work with you?
I would say it's a disadvantage to get access to corporates because we can't leverage the full business done with the corporate and the services given by the bank. Still, at AXA IM, we manage cash pooling for AXA Group. so a big insurance company. So we imagine that the constraints and the setup and the need for liquidity are high. So there is a pretty strong standard for investment. So it's also helpful to be independent, not biased to buy the paper issued by the mother family or the mother company, sorry. And for example, we don't buy any AXA paper in our portfolios. So that's the rule. We don't do that. Then I would say we are able to get access, to diversify, to maybe we see that it's also a way of diversifying the asset managers for corporate.
Diversification of asset managers.
Yes, I agree. As a Swiss private bank, it's quite difficult to have access to corporates. But I agree with what Mikaël just said. So diversification is important within the portfolio, in the cash allocation, but also maybe diversification in terms of counterparty you work with. So, for example, you use your core banks for your core needs, and then for money market funds, you can look elsewhere to make sure that the scope of tools are well used across all the possibilities. And yes, also maybe some non-core banks offer sometimes quite unique investment process or investment approach to diversify themselves from or to differentiate themselves from the competition. And this is what we just explained. So it's a way to diversify the counterparty risk, as the underlying assets are usually or quite often different from a core bank's money market fund.
Oh, it's interesting. And so, if I understand well, so it's good to have a second level of diversification, not to concentrate on one or two money market fund, let's say supplier, but maybe to have more. It also depends on your size, because I guess that if you have a huge pile of excess cash, you have some internal limits, and depending on the size of the fund also, it's quite important to make sure that you respect the size. You don't want to be too important in terms of the total size of the fund. Is it something that your customers are looking at, the size of the fund, and what is the maximum investment?
There are some maximum exposure, so most of the corporates and clients look at the size and the ratio they've got, so they won't go beyond a certain amount in the fund to make sure that, I mean, they want to keep a high level of liquidity, meaning that they know if they have to redeem or go with a significant amount, they can put the fund at risk. So they prefer to be smaller in a fund, be in a selection of several funds to get access to this liquidity. So I mean that's part of the criteria most of the companies have in place.
And have you also noticed this increase and boost for the ESG funds, or is it something that you?
Hard to say, because most of the funds now are articulate or have a label, so it's hard to differentiate. Sometimes it's required. Maybe you had a kind of acceleration 3 years ago. So we were talking about possible Article 9, sustainable fund and so forth. Now, let's say it's back to something a bit more normal, meaning that articulate is required, label is a plus, but there is no appetite so far to go much beyond that to try to get Article 9. And on that front, it's too early, because there are not enough depths in the market to buy some green CP or green bonds to be 80% invested in sustainable investment as required by SFDR for Article 9.
But yes, ESG has become an important factor for money market fund, even for money market funds. And here again, as we previously mentioned, it's important to see and to understand how the fund implements the ESG process, because there is no standard in the market. So you can be on Article 8, but maybe not aligning the ESG factors with the investors. So it's very important, again, to look at the fund, the underlying assets, the way the fund implements the ESG tools, and then select maybe the fund managers from an ESG standpoint that align a bit more the ESG factors with your own convictions.
Maybe a last comment from you. So sometimes it's difficult, and I remember discussion with some of our members. So what will be the key, let's say, element you will, let's say, advise to use to convince the C-level that money market fund should be really a good alternative?
But I think if you look at the risk-return profile first, the returns are very attractive. Given that we are talking mostly about AAA rated funds. So if you compare, for example, with the bank deposit, which is maximum in the AA space or single A space.
Or even not rated.
So you have a very good risk return profile. Again, you delegate your cash allocation to a professional that can look at all the risk management tools and so on and so forth. So I think it's not a no-brainer, but it's very important to take into account the money market funds. They offer, as I said, very nice returns while mitigating quite a lot the risk or impact of negative events.
Maybe the normal criteria: daily liquidity, low risk, easy to use, cheap. Also, maybe it's not only money market funds and nothing else. So it can be a mix of term deposit, cash account, and money market funds. And maybe we had a chat earlier on. Maybe just remember that money market funds have been launched in the 80s in the US and then in France later on in 85 something. It was because corporates were looking for low-risk, liquid investment vehicles and being able to get a return that was several percent at the time. So the reason why they've been launched was to fill the gap and maybe please some corporates that were not remunerated at all with the cash account. So the reason is still there. So I would say we just have to have it in mind, and they have been made for the need of corporates.
Okay, thanks a lot. So